It's Sunday night. Most of North America is offline, markets mentally closed, attention drifting elsewhere. But on my screen, something is unfolding that doesn't wait for headlines or morning briefings. What I'm seeing out of Shanghai right now is not normal, and before we go any further, you need to understand that clearly. I've spent decades analyzing commodity markets. I've seen squeezes that went nowhere, panics that were manufactured, and narratives designed to distract more than inform. I don't react to noise. But as Asian electronic markets opened tonight, silver didn't creep higher or grind upward. It moved vertically, fast, aggressive, and without hesitation. That kind of price action at this hour under these conditions is never accidental. Here's the uncomfortable truth. The number on your screen is starting to lose meaning, not because the market is irrational, but because the structure underneath it is under stress. The paper price is still updating every second, but the physical metal behind that price is not behaving the way it always has. And when physical delivery stops working smoothly, price becomes a narrative, not a reflection of reality. Just 11 days ago, China quietly changed the rules. New export licensing requirements, new controls that sound administrative until you look at the effect. Silver produced in China stays in China. Silver refined in China stays in China. And now the downstream consequences of that decision are surfacing inside the most important physical silver market in the world. This is not speculation and it's not hype. It's about whether the system can still deliver real metal when someone stands up and demands it. In the chapters ahead, I'm going to break down the data, the mechanics, and the warning signs that most people won't see until it's too late. By the end, you'll understand why the next 72 hours matter and why mistaking paper exposure for real ownership can be an extremely expensive lesson. Stay focused. This is moving fast. To understand why this moment matters, you have to stop looking at silver the way most traders do. This isn't a chart story. This is a plumbing story. While commentators argue about resistance levels and moving averages, the real stress is building where almost nobody looks inside the physical delivery system itself. Let's anchor this in time. It's January. The Asian markets are open and silver is trading near levels that would normally attract sellers. In a healthy market, higher prices pull metal out of hiding. Supply responds. Spreads stay tight. But that isn't what's happening. The bid-ask spread is widening, not narrowing. That tells you something critical. Holders of physical metal are reluctant to sell, not because they expect a quick dip, but because they're unsure they'll be able to replace what they give up. This hesitation isn't emotional, it's rational. The Shanghai Gold Exchange is the backbone of global physical silver delivery. When industrial buyers need real metal, not promises, not contracts, but bars they can melt and use, this is where they go. And right now that system is showing signs of strain that go far beyond normal volatility. Over the past few sessions, silver inventories inside Shanghai-linked vaults have been draining at a pace that simply doesn't line up with replenishment. Metal is leaving faster than it's coming in. In isolation, that wouldn't be alarming. But combined with China's new export controls, it creates a closed loop. Metal exits the vaults, but it doesn't circulate back into the global system. This is the core tension. The paper market assumes mobility. Contracts assume delivery, but policy has changed the rules of movement. When the world's largest refining and manufacturing hub decides to prioritize domestic demand, the rest of the system feels it immediately, even if the headlines lag behind. What you're witnessing now is the early phase of a physical stress event. It starts quietly with spreads, with inventories, with subtle signals most people dismiss. Then suddenly everyone notices at once. And by then the choices are already gone. Now let's talk about why silver is different, because this is where a lot of people get blindsided. Gold can sit in a vault for decades and nothing breaks. Silver can't. Silver is not a passive asset. It gets consumed. It disappears into supply chains, factories, and finished products, and once it's used, it's rarely recovered in meaningful quantities. Every solar panel requires silver. Every electric vehicle requires silver. Every push toward electrification, renewable energy, and grid expansion quietly increases silver demand in ways that are structural, not cyclical. Governments can slow spending. Consumers can delay purchases. But once factories are built and supply contracts are signed, the demand becomes non-negotiable. This is why the stress we're seeing in Shanghai matters so much. When industrial buyers stand for delivery, they're not doing it to speculate. They're doing it because production schedules depend on it. If metal doesn't arrive, assembly lines stop. Missed delivery doesn't mean delayed profit, it means broken contracts. What makes the current situation dangerous is the mismatch between how fast silver is leaving the system and how slowly new supply can respond. Mining isn't flexible. You don't flip a switch and produce more metal. New supply takes years, not weeks. And recycling can't fill the gap at scale, especially when industrial demand is rising at the same time. This creates a fragile equilibrium. As long as inventories are high, the system looks stable. But once confidence cracks, behavior changes fast. Buyers rush to secure delivery. Holders refuse to sell. Liquidity evaporates. And the paper market, which depends on the assumption that metal can always be sourced, starts to detach from reality. That's the phase we're entering now. Not a panic yet, but a transition. The moment when quiet shortages become visible stress. And once that threshold is crossed, the market doesn't move gradually. It reprices. In the next chapter, we're going to look directly at the inventory math and why the timeline matters far more than most people realize. Let's put numbers on this because once you do the math, the situation becomes much harder to dismiss. Markets can ignore opinions, they can spin narratives, but they cannot argue with arithmetic for very long. The Shanghai linked vault system holds a finite amount of silver. It's not an abstract pool, it's a measurable stockpile. Recent reports show inventories hovering in the low hundreds of tons, not thousands. That matters because withdrawals are accelerating. When you see a single-day outflow measured in double-digit tons that's not routine usage, that's stress behavior. Here's why the timeline is critical. Even if we assume that those large withdrawals don't happen every day, the average drawdown rate still implies a runway measured in weeks, not years. And that's under optimistic assumptions. No surge in industrial demand, no panic withdrawals, no hoarding, no strategic stockpiling. Real markets rarely behave that politely. What happens instead is game theory. Once participants believe supply may not be available later, the rational move is to secure it now. That behavior feeds on itself. Each withdrawal increases pressure on the remaining inventory, which increases urgency for the next buyer. The system doesn't fail because demand explodes overnight. It fails because trust erodes. At the same time, replenishment is constrained. Export controls slow inflows. Domestic priorities redirect metal before it ever reaches the exchange. Refiners don't rush to sell when replacement supply is uncertain. So you end up with a simple but dangerous imbalance. Metal flowing out faster than it can come back in. This is how physical markets break. Not with headlines, but with silence. No announcement, no alarm bell. Just inventory lines trending down until suddenly there's nothing left to smooth the shock. In the next chapter, we're going to talk about why exchanges respond to this kind of pressure in very specific ways, and why those responses often signal more trouble, not less. When exchanges sense this kind of pressure, they don't wait for confirmation. They act preemptively, and the first place that shows up is margin policy. Margin hikes are not cosmetic, they are a signal. A message from the exchange that says volatility is no longer theoretical, and counterparty risk is no longer abstract. Raising margin requirements forces participants to post more cash for the same exposure. On the surface, it looks like a risk management tool, and technically, that's what it is. But beneath that, it's a stress response. Exchanges raise margins when they're worried someone somewhere won't be able to perform. Think about what that implies. If this were just a paperwork delay or a temporary bottleneck, margins wouldn't change. Paperwork doesn't cause defaults. Supply stress does. When an exchange tightens margin requirements aggressively, it's preparing for the possibility that prices move fast, that positions blow out, and that some participants won't survive the move. This is where leverage becomes dangerous. Leveraged longs can get wiped out on pullbacks. Leveraged shorts can get wiped out on spikes. And when liquidation begins, it doesn't discriminate. Forced selling and forced buying both amplify volatility. The market feeds on its own instability. What makes the current setup especially volatile is the imbalance of expectations. A large portion of the market still believes recent highs were the top. Models assume mean reversion. Algorithms are positioned for normal behavior. But normal behavior assumes delivery works, liquidity is real, and inventory is available. If those assumptions fail even briefly, the unwind can be violent. Short positions scramble to cover. Liquidity disappears. Prices jump, not because of enthusiasm, but because there's nothing left on the other side of the trade. Margin hikes don't cause crises, they reveal them. They tell you the exchange is bracing for impact, and when you see them combined with inventory drawdowns and widening spreads, it's no longer noise. It's a coordinated signal. Next, we need to talk about the legal escape valve exchanges use when delivery becomes impossible and why that moment changes everything. This is where many people fundamentally misunderstand how exchanges really operate. When physical delivery becomes strained, the system does not announce failure or ring alarm bells. It moves quietly, reaching for a clause buried deep in the rulebook that most participants never read closely. Force majeure. Force majeure allows an exchange to claim that circumstances beyond its control have intervened. In practical terms, it is an escape hatch. A contract that explicitly promised physical silver can be converted into a cash settlement. On paper, this is legal. It complies with the rules. But in real economic terms, it is a failure to deliver what was promised. If you expected metal and receive currency instead, you have not been made whole. You have been redirected into something fundamentally different. For a trader, that may be an inconvenience or a missed opportunity. For an industrial buyer, it can be catastrophic. Cash cannot keep a production line running. Cash cannot replace silver that was supposed to arrive on a specific date. The real danger of force majeure is not the clause itself, but the expectations it creates. The moment market participants believe delivery may be suspended. Behavior changes immediately. Buyers rush to stand for delivery earlier than planned. Holders become unwilling to sell or lend. Trust erodes, liquidity thins, and stress compounds. Exchanges always frame these actions as temporary, procedural, and controlled. But markets have memory. Once confidence in delivery breaks, it does not recover quickly. Paper prices may continue to print, charts may still move, but their meaning shifts. The market stops asking what is silver trading at and starts asking, can I actually get it? That psychological shift is subtle, but it's how physical markets move from tension into real crisis. This is the point where rumors start to matter even before they're confirmed. In a stressed physical market, information doesn't need to be perfect to be powerful. It just needs to be plausible. And right now, the whispers circulating through Asia fit the data too well to ignore. When buyers hear that delivery requests are being partially filled or that expected tonnage is arriving in fractions rather than in full, the reaction is immediate. They don't wait for press releases. They don't wait for confirmation. They act. They secure alternative supply. They pay premiums. They pull metal out of the system while they still can. That behavior shows up in one place first: premiums. When physical silver begins trading far above the quoted spot price, the market is telling you something simple and brutal. The quoted price is no longer the clearing price for real metal. It's a reference point for paper transactions that assume availability. Premiums don't spike because traders are emotional. They spike because sellers are scarce. Owners of physical metal start to believe that what they hold will be harder to replace tomorrow than it is today. So they demand compensation for that risk. The higher the uncertainty, the higher the premium. This is also where geography matters. Stress does not distribute evenly. One region feels it first, then it spreads. Asia tightens, Europe reacts, North America lags. By the time retail investors notice, the professionals have already repositioned. Unconfirmed delivery shortfalls may never be acknowledged publicly, but they don't have to be. Markets don't wait for admissions. They respond to incentives. And right now, the incentive is to treat physical silver as scarce even if the official story says everything is fine. In the next chapter, we'll examine how this environment sets the stage for violent price moves and why leverage turns from a tool into a trap when physical supply is questioned. This is where the structure of the market turns tension into acceleration. When physical supply is questioned, leverage becomes the amplifier. It doesn't create the move, but it magnifies it often in ways that surprise even experienced participants. In a leveraged system, small price changes have outsized consequences. A move of a few dollars in silver can trigger margin calls, forced liquidations, and automatic covering. When that happens, trades stop being voluntary. The market takes control. Positions are closed not because someone changed their mind, but because they ran out of room. Short positions are especially vulnerable in this environment. Many are built on the assumption that recent highs marked a top, that prices will revert, and that physical constraints are temporary. But when price moves higher instead and delivery risk enters the equation, those assumptions collapse quickly. Each forced cover pushes the price higher. Each price spike forces the next wave of shorts to exit. This feedback loop is what turns orderly markets into vertical ones. It's not enthusiasm, it's mechanics. At the same time, liquidity disappears. Sellers step back. Market makers widen spreads or pull quotes entirely. The price jumps not because demand explodes, but because there is nothing to absorb it. This is how markets gap. This is how price discovery breaks. What makes this moment dangerous is uncertainty. No one knows how many leveraged positions are out there or where their breaking points lie. That unknown is what keeps professionals cautious and volatility elevated. In the next chapter, we'll step back and look at how institutions tend to respond when this kind of instability threatens the broader system, and what signals to watch as they attempt to regain control. When volatility reaches this stage, institutions don't react emotionally. They react strategically. Their priority is not price stability or fairness, but containment. Preserving the system matters more than protecting individual participants, and history shows that clearly. The first response is usually quiet intervention. Rules are adjusted, settlement terms are clarified, trading conditions are tightened. These moves are framed as routine risk management, but their purpose is to slow the feedback loop and prevent a disorderly unwind. When that fails, stronger measures follow. We've seen this before in other commodity markets: trading halts, emergency rule changes, retroactive adjustments. When physical shortages collide with leveraged paper exposure, exchanges choose survival. That means protecting clearing members and major counterparties, even if it comes at the expense of price discovery. This is why relying on precedent can be dangerous. Many investors assume the market must behave the way it always has. But when stress reaches a certain level, the rules are no longer static. They become flexible. And flexibility almost always favors those closest to the system. At the same time, messaging becomes controlled. Coverage softens. Volatility is downplayed. Silence replaces transparency. This isn't about conspiracy. It's about avoiding panic while decisions are made behind closed doors. For participants watching closely, these signals matter more than headlines. Rule changes, margin shifts, settlement language, and unexplained delays all point to the same thing. The system is absorbing shock. In the final chapter, we'll bring everything together. The strategy, the lessons, and the mindset required to navigate a market where physical reality matters more than quoted prices. Now, let's bring this together because this moment demands clarity, not noise. What we're witnessing is not a random spike or a speculative frenzy. It's the consequence of structure policy and physics colliding. Silver is leaving the system faster than trust can replenish it, and once that balance breaks, markets don't negotiate. They reprice. The lesson here is simple but uncomfortable. Paper instruments work beautifully until they don't. They assume liquidity delivery and orderly behavior. Physical markets don't care about assumptions. They care about availability. When supply tightens and confidence fades, the person with real metal holds the leverage, not the person with the most sophisticated contract. Strategy in this environment is not about predicting the next dollar move. It's about understanding risk asymmetry. Downside is capped for those holding real assets they don't need to liquidate. Upside is open-ended when shortages collide with leverage. The danger lies in overexposure, in assuming rules won't change, and in confusing access with ownership. The broader lesson goes beyond silver. This is how stress reveals truth across all markets. When systems are comfortable, promises are interchangeable. When systems are stressed, only what can be delivered matters. Everything else becomes negotiable. Over the coming days, stay focused on signals, not headlines. Watch behavior, not narratives. Inventory flows, delivery language, margin policy, and premiums will tell you far more than commentary ever will. And above all, understand what you actually own. If this analysis helped you see the market more clearly, make sure you're subscribed so you don't miss what comes next. Share this with someone who still thinks price and reality are always the same thing. And leave a comment below with how you're positioning yourself in this environment. The conversation matters, especially now.